Hello and welcome to the macro of it for the week beginning the 31st of July 2017. Can forget what's going on today. It's not really a huge amount, and I think what we've been talking about in July is already a given. So being the start of a new month, being August, it does therefore mean it's central bank week, and it's always a very interesting week to sort of listen to what all the central banks have to say. Starting on Tuesday, and it is ours, the RBA, it's going to be really interesting to see probably what happens around forecasts of inflation. Last week we did see a really soggy figure on inflation, and it clearly shows that their mandate of looking at keeping trim mean inflation between 2 to 3% is a reasonable way away, and their Goldilocks figure of that 2.5 to get back to a neutral cash rate of 3.5% is a very long way away. I think the hawkish hood, particularly at Philip Lowe, is now well and truly back on, and I think you'll see that. I actually now believe that they're probably out of the market. They're going to sit on the fence for the foreseeable future, at least through 2017. Expectations, if you do want to look at any form of changes in the market, the current expectation is that the earliest would be March next year for a rate rise, and that is very low anyway, at about a third. So that's where the RBA is. It's very much out of the market, but watch that inflation. It therefore does sort of go to GDP, expectations around growth, also confidence as well. So it will be a part of it, but it's not going to be anywhere near as big as what's happening at the back end of the week. On that, there are a whole plethora of data coming out of the US, ISM numbers, there's inflation coming out of Europe as well, but I do want to concentrate again on those banks. And the reason for it is that you are seeing signs, particularly at the ECB, which is happening on Thursday night, that they may move rates. Now, what I want to clarify around that is that what they're moving in those rates. Everybody talks about when rates moves, it therefore means that lending's increasing, monetary policy tightening. They're a bit different. They have three rates that they give out, and the one you're going to have to concentrate on is the deposit rate. That's basically the rate that the banks, private banks, are charged for having money at the ECB. It's negative, and that's why I say charged. There is a growing belief that they may move that back to neutral, so dead zero. And that therefore means they're not really changing anything at all, because the lending rate is currently between 0 and 0.25 of 1%. Sorry, in terms of what they're sitting on, and that's really not going to change anything at all. But it does signal that Europe believes that things are actually starting to improve and they can start normalising policy. Now, I say normalising very loosely again, because their policy is so incredibly unconventional and so loose that even with this kind of change, it's still, under normal theory, a very open area. And that's what may be an interesting sort of movement over the next couple of years. It may put a bit of a dampener on growth in the DAX. It also might do it in the CAC. So just watch that from an equity side. If you do see those markets under a bit of pressure, it could start to filter out globally, particularly if it moves into the US. The US has been looking for almost anything to sort of be a reason for taking profit. And then for moving to the other side of the Atlantic and looking at what's going on over in the US, ISM numbers, as I said before, but there is a whole heap of Fed speak next week. Again, this week's been very interesting. We had their rates, which what was going on last week, and the fact that they are sort of pushing away from the probability of having a rate rise in December. Keep an eye for that. So there is three major speakers. I think the one you really need to look at is John Williams. He comes out on Friday. But you also have the non-farm payrolls. And the reason they're becoming key, getting back to the statement that we saw from their statement last week, is that it's all about the inflation wage inside of it. Janet Yellen herself has said that inflation is now running below their expectation, and it is down to wages. Wage growth in America is just the same as it is here. It is not moving anywhere near the rate that people would have expected. So those non-farm payrolls, try and look for through the headline figure, although it will move probably currency markets quite quickly. If there is participation continuing to move to the downside and wages just aren't moving in the direction they want to, just gives another feather to those that are betting that December's off. It therefore would be a US dollar weakness. It'd be an Aussie dollar positive, and that could therefore mean that you wake up Monday week and seeing us under even more pressure. So next week's a really interesting one. It's central bank policy, and I'm sure it'll be one that sort of really gears up for how the second half of the year will look.
We set up InvestSMART to democratize the investment planning process for low balance clients. You know, it's those clients that can't afford to go to a financial planner. We've built a lot of the tools inside of InvestSMART now with the Portfolio Manager and the Health Check. We've launched a lot of our own low-cost products. If you're disciplined and you diversify your portfolio and listen to some of the experts that we have on our services telling you about what to do and what not to do, then I think you can easily reach your investment goals over time.